Great. Thank you so much, Yang, for the introduction. And thank you all today for joining me to discuss US banks and global liquidity. This is joint work with Ricardo Correa and Gordon Liao, my former colleagues at the Federal Reserve Board, who are also here with us today. And the usual Fed disclaimer applies. Everything we say today, even including the Q&As, are our own views. Okay, so let's get started. To first give you some motivation, we know that in recent years, we have seen frequent spikes in the short-term US dollar interest rates. For instance, you may remember last September, we saw the US dollar repo rate went up to 10%. And in addition, since global financial crisis, we have seen a persistent failure of the textbook no arbitrage to cover interest rate parity relation, which implies a wedge between the direct dollar interest rate by borrowing dollar in the cash market and the implied dollar interest rate by borrowing dollar in the FX swap markets. Okay. So this evidence suggests there has to be some form of frictions in the global intermediation of global dollar funding. And who are the most important intermediaries? We think global banks remain at the center of global capital markets. So therefore, the goal of today's paper is to figure out what do global banks do exactly in terms of intermediate dollar funding during these episodes of dollar funding shortages. Our key result is that the reserve-based intermediation has become the dominant way to intermediate dollar funding during episodes of dollar funding shortage post-GFC. So what this means is that we see that in days when the dollar funding condition is tight, from large intermediary perspective, for instance, say take the view of large US banks, they do increase their short-term dollar lending because this is more profitable. However, how do they finance it? They finance it via reducing their extra cash held in the form of excess reserves at the Federal Reserve instead of borrowing additional dollars from cash-rich lenders such as money market funds to finance that additional lending. So this distinction between borrowing dollars from someone else in order to provide additional lending versus running down the bank's own cash balance at the Fed to finance it is important because this gives us a pretty valid arguments in favor of running an ample amount of reserves for the whole system to safeguard the well-functioning of global dollar funding markets. Okay. So furthermore, we also demonstrate that in order for this reserve-based intermediation to operate smoothly, we need sufficient amount of intra-firm liquidity transfer between the traditional banks, the commercial banks that actually hold reserves, to the affiliated broker-dealers or these shadow banks within the same bank holding company, because they actually do most of the repo and FX swap market-based lending. And we'll show you evidence that this intra-firm transfer is large and sizable, and it fluctuates well with the dollar funding conditions. Okay, so in terms of the exact empirical exercise, we're going to be zooming at 3 types of dollar funding shortages. The first type of dollar funding shortage is we'll be looking at quarter ends through the lens of US banks. Why is quarter end special? Quarter end is special because in many non-US jurisdictions, the Basel III leverage ratio is calculated based on the quarter end snapshot of bank's balance sheet. As a result, non-US banks have a significant incentive to contract or to reduce the size of their balance sheet on quarter end days in order to have better reported leverage ratio. And this caused a big contraction in the supply of dollar intermediation service by non-US banks. US banks, on the other hand, have their supplementary leverage ratio calculated based on the daily average of their balance sheets. Therefore, it is a very interesting empirical question to see whether and how US banks respond to these quarter-end dollar funding shortages. Okay, so that's the first shock or first type of dollar shortage. The second type of dollar shortage is we're going to be looking at days where the Treasury General Account experienced a large increase in its balance. So what the Treasury General Account is, this is the US Treasury's cash pile at the Federal Reserve. An increase in the Treasury's extra cash at the Federal Reserve, other things being equal, corresponds to a contraction in the overall cash for the entire banking system. So therefore, this also caused a significant strain in the dollar funding markets. And thirdly, we look at the days that the Federal Reserve reduces its portfolio holding. So this was a feature in the main part of our sample between 2017 and 2019, when the Federal Reserve actively reduced its balance sheet size through the well-known quantitative easing tapering. Okay. So what we find is that in response to these three types of dollar funding shortages, large US banks do supply additional dollar funding in the two most active short-term securitized funding markets in terms of they lend more in the dollar repo market, and this shows up as an increase in the reverse repo position on these large banks' balance sheets, and they also lend more in these other globalized version of the short-term collateralized lending markets, that is the foreign exchange swap markets that I will be more specific just shortly. Okay, so please feel free to jump in if there's any clarifying questions. All right, so the data that we're using for this taper is new. This is FR 2052A, which is the regulatory filings for the Basel III liquidity coverage ratio. So it's a very nice data set because it gives us a detailed daily snapshot of individual banks' asset inflows and liability outflows by currency on a consolidated basis for the bank holding company, but as well as for the material subsidiaries within the bank, okay? So if we're interested in these high frequency type of liquidity provision in the repo and FX swap markets, a large part of the volume is overnight. So having the overnight or daily snapshot of bank balance sheet is very, very valuable. So we're able to manually map these inflows and outflows from this LCR reporting to the usual looking asset and liability line items for the whole bank and also for an important subsidiary. Okay. So the main sample period is from December 2015 all the way to last September 2019. We recently extended sample all the way to May 2020 to cover the recent COVID-19 induced dollar funding shortage. The start time of the sample is constrained by the availability of daily reporting, which began in December 2015. Okay, so we have 6 banks in our study. These are the largest. There are only 8 GSIBs, which stand for Globally Systematic Important Banks in the US. We look at 6 of them. They are Bank of America, Citi, Goldman Sachs, JP Morgan, Morgan Stanley, Wells Fargo. We dropped the 2 custodian banks, the State Street and Bank of New York Mellon, just because they run very different business model. All right. So as a background, I want to take a minute to discuss the evolution of the Fed balance sheet in our main sample period. As you can see, this first vertical line denotes the daily start time, daily data start time for our sample. And this is the end of our main sample period. Last September, the repo market hit a liquidity pothole. The next day on September 17th, the Fed repo facility was reestablished. So during this main sample period that you see, this is an interesting period that the Federal Reserve actively reduced its portfolio holding. So what is this light blue area? That's the Fed holdings of treasuries and mortgage-backed securities. You see that it was at a very high and steady level. And when we were in the second half of 2017, the Fed tapering started. Okay, so how is this Fed QE portfolio financed? Through a few major liability items plotted here in the negative territory. You see that despite the progress we have made in digital payment, there's been a steady growth of currency in circulation. So that's the light yellow area. The focus of today's talk is going to be this red area. That's reserves or bank reserves. This is bank's extra cash pile or cash pile. They may not be extra, as we will discuss shortly. So this is bank's cash pile at the Federal Reserve. And what is this purple line? The purple area is important too. This is our second type of dollar funding shortage. This is the Treasury General Account balance, or the Treasury's cash pile at the Federal Reserve. So what you see is that a distinct feature of our sample is that the bank reserve, or bank's cash at the Fed, reached their multi-year low at the end of our sample period for a couple of reasons. First obvious reason is the Fed was actively reducing its balance sheet size through the balance sheet normalization process. And the second, also very significant factor, is we have a steady expansion of currency in circulation. Okay, and towards the second half of our sample, this purple area also expanded modestly. All right. So that's a good background. And we know that expansion of this purple area, other things being equal, would correspond to a reduction in the red area, or the bank reserves. So that's, in a sense, we think a larger TGA balance also translate into tighter dollar funding condition. Okay, so now it's time to actually show you this data before we do any formal analysis. So this slide shows you the US dollar denominated balance sheets for the combined 6 banks in our sample. Everything is in dollars. We see assets plotted in the positive territory and liability plotted in the negative territory. You see that the largest asset item is the risky or rather illiquid loans, the green area, and the largest liability item is the greenish area, the deposits. Okay, so our focus today is colorful regions that's in the middle of this chart. So these are the reverse repos, largely backed by the repo position, cash and reserve balances, and treasury securities. So what makes these colorful areas stand out is we think they are very liquid and they are very scalable. Scalable in a sense, they're under the control of the bank, that the bank can decide to proactively change the positions of this colored area on a short notice, on a high frequency, like at daily or even intraday frequency. Whereas for the green area, like the loans and the deposits, it takes longer to original loans. Deposit takings are more passive process and takes longer to, say, set up the deposit franchises to attract more deposits. So those are not as scalable. Okay, so that's the picture for the dollar denominated balance sheet. The picture looks quite different if we were to look at foreign currency denominated balance sheet. So this slide shows the euro, the yen, the British pound, and the Australian dollar denominated balance sheets for our US banks. You see is that the green area, the loans and the deposits have actually largely subsided. They faded away from the picture. You see the colorful areas become more prominent. So these short-term scalable components of bank balance sheets play a significantly larger role in the non-USD denominated balance sheets for our US banks. And we think a large part of this non-USD denominated scalable component of balance sheet is actually used to finance US dollar intermediation for our US GSIBs. Okay. All right, to fix terminologies, I want to first formally introduce you to these two types of dollar lending or dollar funding markets, depending on your perspective. So let's take a perspective of large bank. The first way that a large bank, say JP Morgan, want to lend in a collateralized way is to lend that dollar in the repo market. So in this transaction, we see that the JP Morgan lends out dollars at the inception of the trade at time T, assuming it's a 1-period loan. At the maturity of the trade, the borrower is going to repay the dollar. Okay, so in what sense this is collateralized? It is collateralized in a sense at the inception of the trade, and in receiving the dollar cash, the borrower has to post some collateral, typically US Treasury security. And at maturity of the trade, if the borrower repays the dollar cash, JP Morgan is going to return the collateral. So that's the canonical cash flow diagram for a repo market transaction. And in terms of terminology, we say that the JP Morgan, after doing more repo market lending, now has more position, a higher position as a dollar reverse repo position. Okay, so in terms of measurement, how much of repo lending the JP Morgan or the US 6 banks in our sample are doing in total, it's easier to figure out because we can just read it off their balance sheet to figure out how much reverse repo position that these large banks have on their balance sheet. Okay, so that's the repo market example. The next example is the dollar lending in the FX swap market. So as we argue in this paper, this is a very synergistic market with respect to the dollar lending. You can think about this as the off-balance sheet cousin to repo lending. Or if you like, you can also think about this as an offshore cousin to the repo market lending. So in what sense this is also a securitized lending? This is a securitized lending in the sense that the bank is lending dollars against the collateral. Here, the collateral is not US Treasury securities or other bonds. In this case, it's foreign currency. And how does it actually work in practice? Again, you see you have a large bank here, JP Morgan, wants to lend out dollars to some ultimate USD borrower. In this case, the dollar doesn't go directly to the borrower. It goes through an intermediary where we label this as FX swap market, which means there is a dealer in the FX swap market that's intermediating this dollar cash. Okay. What's the collateral? So in exchange to receive the dollar cash from the intermediary, from the dealer, this USD borrower has to post some Japanese yen. And this yen, again, gets intermediated back to JP Morgan. All right, so this transaction typically occurs at the spot exchange rate in terms of the rate that the dollar is exchanged for yen. So where does the JP Morgan park that yen? Now it doesn't have as much dollar, but has more yen because we think JP Morgan is in the market making business for the lending dollar in the FX swap market. It is not going to risk credit risk. So we think there are two most likely scenarios. The first is to park that yen literally as extra cash at the Bank of Japan deposit facility. The second scenario is to on-lend that yen into the Japanese repo market. So you lend out the yen against the Japanese government bond as a collateral, again, credit risk-free. So that's the inception of this trade. The bank lends out dollar through the FX swap market. At the maturity of the trade, all the cash flows reverse. The USD borrower repays the dollar to the dealer. The dealer gives the dollar back to JP Morgan. And JP Morgan is going to get back his Japanese yen with certainty, either from Bank of Japan or from the yen repo market. It's going to pass that yen cash to the FX swap market dealer, which then goes back to the USD borrower. In this case, the exchange rate between dollar and yen occurs at a forward exchange rate that is known or pre-contracted at time t. So this is in the sense, this transaction is free from currency risk because the spot exchange rate for this leg is known today and the forward exchange rate is already pre-contracted today as well. So also known. So if you like, this is really just a way of collateralized lending, or from borrower perspective, collateralized borrowing with the Japanese yen being the collateral for dollar funding. Okay, so the empirical challenge to figure out the exact extent of these type of activity is that the FX swap transactions involve derivatives. They are off balance sheets and therefore unobserved. However, we do observe the on-balance sheet footprint for these activities because we see the on-lending or we see the additional reserve balance at the Bank of Japan, right? So therefore, our proxy for the short-term FX swap market lending in US dollars for our US banks is to take the sum of the foreign currency excess reserve balances at various central banks, the Bank of Japan, the European Central Bank, Bank of England, for example, plus the additional net repo lending that these banks are doing in foreign currency. In the paper, we also discussed an alternative robustness measure for this FX swap market lending proxy, and that is taking the total gap between foreign currency assets and foreign currency liability assuming that these large global banks perfectly hedge the currency position of their assets and liability, which is a good first order approximation because any naked FX exposure is going to have a large regulatory penalty. And we do find very similar results using this alternative measure for FX swap market lending. Okay, so the next thing we want to show you is how much are these activities based on our proxy. And they're fairly large. You see the blue line shows the amount of reverse repo position or the amount of dollar lending in the repo market done by our 6 sample banks, and they fluctuate between 1 trillion and 1.4 trillion, so a very large number. And in terms of dollar lending in the FX swap market, our proxies shows between 300 and 400 billion dollars. Okay, so we plot these two lines in the context of the total amount of reserve balances that these banks have at the Federal Reserve. Note that not all of these reserves are sort of freely deployable. So not all of them are truly extra, as we'll also discuss shortly.
Hi, Wenxin. Maybe now is a good time to pause and ask a few questions.
Please.
Now I think we have unmuted you. Could you ask your question, Vania? Vania, I think you are muted.
Oh, apologies. So they're just clarification questions. Do you observe the unconsolidated balance sheet? So for example, if you have the market making division balance sheet, you can back out more precisely the swap activity. Essentially, and I'm trying to understand a little bit more what do you observe for the activity of the foreign banks, or you work only with the US balance sheets?
Yeah, so great question. Thanks a lot for asking that. Yeah, so the huge advantage of this data set is that we observe the global activities of our 6 US banks. So the numbers I have seen showing so far, they are already consolidated at a global level, which include the broker dealers, the commercial banks, both based in the US and outside the US. I'll show you some specific evidence regarding intra-group transfer where we take the broker dealer's position more seriously.
The second question comes from Ina. Ina, you have the right to ask now, but you are still muted. Now we're good.
Okay, great. Hi, Wenxin. Can you just go back one slide, please, where you were describing the strategy for the FX? Yeah, this one. So I was just trying to understand a little bit more this strategy. Do you have a sense of who are these guys who are in the middle? Who are these intermediaries? Because I would have imagined that there were also banks, in which case I expected that you would have data on this. I'm just a little confused as to why there's like this missing middle here.
Yeah. So here I'm vaguely labeling them as FX swap market, but I should have really done is label them as FX swap dealer. So these are the broker dealers in the foreign exchange swap markets. They could well be an affiliated broker dealer within JP Morgan. So this could be JP Morgan Securities based in London or based in New York. Or some other broker dealers. There could also be independent broker dealers, but by and large, the largest ones are always affiliated with large bank holding companies. So they're part of banks. So in terms of derivative reporting, it's pretty tricky. Like for instance, if you think about for this transaction, the net value of the derivative is pretty small. There is a gross volume, so it depends on the reporting. And for this particular data, we just don't have very good coverage of these off-balance sheet positions. There are good data that exist, for instance, that's coming from a trade repository for precisely for these FX forwards and swaps. DTCC is the name for it. For instance, a Bank of England and European central banks have access to the DTCC forward and swap data. So it would be able to.
And in general, there is no like direct, you don't observe any direct activity between JP Morgan and the US borrower? Like there's no activity that doesn't include an intermediary? It always goes through an intermediary? Or
yeah, so most of the swap market lending always goes through a dealer. So okay. So I mean, you can, I think there is possibly like the bank, so the commercial bank does some lending, but for these type of very short-dated repo swap market lending, like the bulk is done by the dealer.
Okay,
the bank does a much smaller part of it. Great. All right, thanks a lot for those clarifying questions. I'm gonna move on to talk about how are these astronomical numbers financed. So broadly speaking, there are two types of intermediation methods to finance short-term dollar lending. So I'm plotting three balance sheet here. Panel A is the baseline. So here I'm only limiting ourselves to the scalable component of the balance sheet. So they have some short-term lending either in the repo or in the FX swap markets, and we have some extra cash. Here the label is drainable reserves, meaning the amount of cash that is truly accessed that banks can deploy to support additional lending if it wants to. And liability side, we have repo and deposits. Okay, so that's the baseline balance sheet. How does the two intermediation method work here? So the first method is what we call the matchbook intermediation. This is the one that maybe you are more familiar with from an intermediary perspective, say on these very difficult dollar cash funding days, like or swap market funding crunch days. What the intermediary wants to do is to increase its additional borrowing in order to finance additional lending and charge the intermediation fee between the lower borrowing cost and the higher lending rate. Okay, so that's the matchbook intermediation. As you can see, a distinct feature as a consequence of doing more matchbook intermediation is now the banks has a larger balance sheet. Right? Because the blue area expands, the overall balance sheet expands. Drainable reserve stays constant. There's an alternative way to do this. That's our panel C. This is called the reserve draining intermediation, the new concept that we introduced in this paper. So how it works is that at the bank consolidated level, they increase their reverse repo or the FX swap market lending, but at the expense of lowering their reserve balances at the Federal Reserve. They don't change their liability, so the overall size of the balance sheet stays constant, right? So you can do more lending, but if you're willing to now have a lower amount of extra cash, it is possible to have a constant balance sheet size. And this might be appealing, especially for banks that are constrained in terms of their total leverage, and especially for banks that are very averse to running a larger balance sheet, especially if you think about on quarter ends when banks face regulatory scrutiny. There are also other benefits that you can think about for this type of reserve draining intermediation over the matchbook intermediation. You can think about on these difficult days, the external financing cost usually goes up as well, even though they may not go up nearly as much compared to the bank's lending rate. But generally speaking, as we'll show you some evidence too, that the bank's borrowing rate does go up as well. So if you, instead of using external funding, but use some internal funding on these difficult days, it is more economical as a result as well. Okay, so however, this all sounds nice, right? I mean, the banks, after doing more reserve draining intermediation, managed to keep its balance sheet size constant. So therefore, doesn't have any effects on the Basel III leverage ratio requirement. And if the repo lending is backed by treasury security, it's also not going to change the liquidity coverage ratio of the bank. But there are still some important considerations that might limit the scope of this type of reserve draining activities. And the reason is there involves some substantial amount of intra-firm transfer for this type of intermediation to go through. And how does this work? Let's take a look at this diagram where we have the bank holding company. This goes back to Vanya's question, right? We talk about these large, complicated banks operated under a big bank holding company, but they have two important arms, the depository institutions and the broker-dealers. Who holds the reserves? Only depository institutions are allowed to hold reserves. That's why we have the red drainable reserves allocated to the depository institutions. And this also goes back to Ina's questions, who are doing most of these repo and FX swap market lending. It's the broker-dealer, a separate entity within the bank holding company. So how can you actually use reserves to support more lending? By default, we have to have some intra-firm transfer that takes the money from draining reserves from the commercial banks or the depository institutions into the broker-dealer arm, right? So that's essentially what we find on these difficult days. The DIs drain their reserves and then lend out that extra cash in the form of internal repo to the broker-dealers, which is then used to finance additional short-term lending. Okay. So we talk about these slides. These two types of intermediation methods face different regulatory and self-imposed risk management constraints. So why are banks doing this? The banks are doing this for a good reason, because they earn intermediation spreads for doing dollar intermediation activities. And how big are these spreads? Depending on which market you're looking at. Generally speaking, 15 to 25 basis points outside these large spiky quarter-end days. So this picture plots you a few important spreads. The blue is the GCF minus the tri-party repo spread. The GCF repo, you can think about this as the higher repo rate that proxies for banks' lending rate to smaller banks or to hedge funds. Whereas the tri-party repo rate is large banks' borrowing rate from a separate market. That's where they largely borrow from money market funds at a more favorable rate. So this gap, the lending rate versus borrowing rate, gives you a proxy for the matchbook intermediation spread for the repo market, right? There's alternative repo spread that we're quite interested. That's the GCF minus the IOR spread. This gives you the spread for doing the reserve-based intermediation for the repo market, because again, the GCF is the lending rate, and what's the IOR? IOR stands for interest on reserve paid by the Fed. So this is the foregone opportunity of parking the money at the Fed, earning the interest on reserve. Okay. And the last one is this FX IOR spread. This is taking the difference between the overnight FX swapped reserve interest on reserve paid by the ECB and paid by the BOJ, compare that to the interest on reserve paid by the Fed. So despite the fact that the BOJ and the ECB deposit rates are negative on the FX swap basis, as you can see, this gold line is always positive, which means they're higher compared to the Fed interest on reserves. Okay, and for the two repo spreads, you see at least in the second half of the Fed tapering sample, we see that the two repo spreads are both positive. The matchbook spread is always positive. The reserve draining based repo spread became positive when the overall balance sheet size shrunk. All right, so now let's go to the...
Sorry to interrupt. We have a few questions. The first question comes from Linda Goldberg.
Okay.
Linda, please unmute yourself.
Yep. Can you hear me, Wenxin?
Yes, perfectly.
Okay. So, I think it's really interesting, you know, that the reserve draining intermediation basically reduces intermediation frictions because you don't have to go and raise funding externally. So my question is about the relationship with the broker dealers and what happened in March. So, you know, a kind of view about March is that some broker dealers ended up having bottlenecks on their balance sheets and could not, you know, intermediate the needs sufficiently. So how do those bottlenecks take place when you have this easy flow of liquidity with the banking, the bank part of the bank holding company through these internal capital markets? So how does that actually happen, given your slide? I think it was like 2 slides ago where you showed the schematic between one more, but yeah, there between banks and broker dealers.
Yeah, great question. I think you're absolutely right. I mean, so maybe we will discuss a little bit, but back in March, there was obviously another dollar funding crunch induced by the COVID pandemic. And a narrative that has emerged is the broker dealers were significantly constrained in terms of their balance sheet capacity in supplying additional dollar. And one constraint could be coming from actually just soaking up additional treasury supply before the Fed launched a massive amount of QE. So even before this March, we saw that the broker-dealers' treasury inventory has actually been rising quite notably, and their own financing needs to finance the additional treasury inventory increase in the absence of having a strong demand from the ultimate buyers of those treasuries. So in that case, if you have some leverage constraints on the intermediaries, that might actually further increase the incentive to use the reserve-based intermediation as opposed to matchbook intermediation. Because, and also in March, right, I mean, the market condition was quite volatile. The external funding cost was also pretty high and unstable. So I can imagine we'll discuss that. So reserve-based intermediation is important, but furthermore, the Fed was also very, very active. So there's also a third option, which is to borrow from the Fed in the repo facility, which also has helped mitigate the funding strain. Yeah, so I'll leave it there, and maybe we'll see a chart towards the end of talk on that Fed official liquidity take-up. All right. So going back to the slides, so it's time to finally talk about quantities. So what exactly did our US banks do to get through these dollar funding shortages? So first, let's take a look at their behavior around quarter ends. Quarter ends are bad. We don't need further motivation. So what happens to the US G-SIBs balance sheet? The easiest way to see this panel is to look at the right-hand side first. So which plot their repo lending and their FX swap market lending. So different from the narrative for foreign banks, for which we know foreign banks significantly contract their repo market lending, what you see in this chart is that the US G-SIBs maintain their repo lending throughout quarter end. There isn't any significant contraction. The repo position, in terms of repo lending position, which is showing up as a reverse repo position on bank's balance sheet, is pretty steady. And interestingly, they increased their dollar lending in the FX swap market based on our proxy by about 20 billion. The next question is, how is this steady amount of repo lending and the 20 billion increase in the FX swap market lending financed? Obviously not coming from additional borrowing. If anything, US banks, like foreign banks, contract their repo borrowing, in this case by 30 billion. So how is it financed? The answer lies in reserves. So everything is coming out of reserve. They drain their reserve balances by about 50 billion, which is enough to offset the 30 billion reduction in repo borrowing. So that's enough to essentially maintain a steady repo lending and the 20 billion increase in the swap market lending. So that's the overall balance sheet for the bank holding company. We can also zoom in at the broker dealer. Again, as we said, the broker dealers are responsible for most of the repo borrowing and lending. That's their job. So what you see here is this speaks to the intra-firm transfer dynamics here. So they reduced about 30 billion of their external financing. So the repo financing from external borrower is down by 30 billion. But there is an offsetting thing going on here, right? They increased their net internal repo borrowing from affiliated commercial banks by about 30 billion, which is enough for them to maintain their steady repo market lending, okay? So this is again the time to comment on any constraints that we may have that place any additional considerations for these type of intra-firm liquidity sharing is going to act as a friction for the well-functioning of these type of reserve-based intermediation method. Okay, and I put down a piece of regulatory consideration. That's the reserve resolution planning rules, which require large banks to actually maintain liquidity within material subsidiary for the resolution planning purpose. Therefore, banks may not want to, say, move a lot of liquidity from its commercial bank arm to broker dealers. It may not want to move its liquidity at the Federal Reserve to the ECB or DOJ because where the reserve is actually quite a significant factor when it comes to resolution planning. Okay. The next thing is, so that's the quarter end results. The next set of results I want to share is regarding the second type of dollar funding shortage on days with large increase in the Treasury General Account balance. So as we previewed at the introduction slide, the TGA is the checking account of the US Treasury at the Federal Reserve. An increase in the TGA balance reduces the overall cash for the banking sector and therefore corresponds to tighter dollar funding condition. It's pretty obvious from this chart. What you see is that we plot the daily change in the Treasury General Account balance in billions of dollars on the horizontal axis, and we plot the daily change in the SOFR minus the IOR spread. What is SOFR? That's the secured overnight financing rate. This is the benchmark that is in the process of replacing LIBOR. So it will be, if not already, the single most important floating rate benchmark. There'll be trillions of dollars of contracts indexed to SOFR. And IOR, again, that's the interest on reserve. So this type of repo spread is very, very sensitive to the TGA fluctuations. And there are two red dots here. This is the September 16. We like to think about last year. We like to think about the $83 billion increase in the TGA act as a trigger for the repo market turmoil. And this was the next day on the 17th. It's off the chart. So this is when the nonlinearity kicked in. Okay, so most of this effect so far, I would say it's approximately linear, but when the market actually hit a liquidity pothole, we got some very wild behavior in terms of the relationship between the repo spread and some observables, in this case, TGA fluctuation. All right, so that's the pricing side. How about the quantity side? The quantity side is very similar when compared to the quarter end results. So here we're running daily regressions of daily changes in balance sheet items on the daily changes in the TGA balance. So what we can see here, for instance, if we want to focus on the lending, so we look at column 2, this is the repo market lending. We look at column 5, this is the FX swap market lending. We see that in response to an increase in the TGA balance, the US banks, so recall the quarter end results, US banks lending, they contracted slightly, marginally significant. Not a huge amount of contraction, but they contract a bit. But they do increase their FX swap market lending, again, modestly. And how is this FX swap market lending and not so big contraction of repo lending actually financed? Not coming from repo borrowing, obviously. So there's a larger contraction in repo borrowing compared to repo lending. So there's a significant increase in the net repo lending. So that's, you can see here. So everything again is coming out of reserves. So reserve balances decline significantly, which is enough to finance repo market lending despite a larger contraction in the repo market borrowing. And that's also enough to finance a modest expansion in the FX swap market lending on these days with large TGA increases. All right. So I will not have time to talk about the change in the Fed SOMA portfolio. If you like, you can think about this as the opposite case to a large increase in the TGA. And we do find qualitatively similar results for the third type of dollar shortage. Okay, so having said that, actually everything I have said so far is for the US G-SIBs reserve balances, which is shown in the blue line here. They are only a part of the reserve holding in the system. The overall supply of reserve, if you like, is actually determined by the Federal Reserve's monetary policy interacting with this private demand for currency in circulation, right? So if you like, that's the exogenous number. So therefore, the distribution of reserves certainly matters. Not just, so we shouldn't just be looking at US G-SIBs in isolation. And therefore, we prepared this chart for you, where we show not only US G-SIBs reserve balances, but also some foreign banks. This is the overall foreign banks reserve balances at the Federal Reserves. So which are the foreign banks that actually have reserve accounts at the Federal Reserve? These are typically large foreign banks with US branches and subsidiaries, and therefore can open a reserve account at the Fed. So all the usual big foreign banks names that you have in mind, they all have a reserve account at the Fed. And then in addition, we also plot other smaller non-G-SIB US domestic banks in red. So what you can see is that in our sample period, the reserve balances for 3 types of players in the markets all trended down to their multi-year low. I think most notably for the large banks, including the US G-SIBs and the foreign banks. For smaller US banks, their reserve balances were largely stable throughout the period. Okay, so it seems like everybody potentially could be hitting a bottleneck in terms of their total reserve balances. So is there anything that we can do to think about whether the reserve-based intermediation is also relevant and important for foreign banks? We don't have as granular of a data for foreign banks when, compared to our daily balance sheet for US banks for obvious reasons, because we just don't have regulatory authority for the whole bank holding companies to see those information. But one piece of information that we do have is we do have the daily reserve balances for foreign banks. So therefore, we also run a similar regressions to analyze the reserve dynamics with respect to the 3 types of dollar funding shortages that we have discussed, not just for US G-SIBs, but also for foreign banks. These are the large foreign banks with US reserve account, for smaller domestic banks, and for some other people's cash. This is the overnight reverse repo balance at the Federal Reserve. You can think about this as non-banks money, also non-US Treasuries money parked at the Federal Reserve. Okay, so this is a table to argue that the distribution of reserve is highly correlated with the dollar funding condition. The distribution matters. It's also a table to shed light some evidence that foreign banks could also be doing a significant amount of reserve-based intermediation for dollar funding. So how do I say that? I say that is because if you compare to column 1, which is our baseline results for US G-SIBs, we see that their reserve balances contract significantly on quarter end, bounced back after the quarter start, the new quarter starts, significantly contracts with respect to large TGA increases, and expand significantly with respect to a Fed increase in its portfolio holding. We actually find qualitatively similar results for the large foreign banks as well. So there is actually a sharper, larger quarter-end effects. There is additional factor at play here because relative to US banks, foreign banks were also engaging in additional arbitrage called interest on reserve arbitrage by borrowing in the dollar cash market overnight and literally park that money at the Fed and reduce that activity significantly on quarter end, which explains why these numbers are even significantly larger than numbers that we saw in the first column. But we cannot rule out they are also doing some meaningful amount of reserve-based intermediation for this global dollar funding market. So both large banks are reducing their reserves. The reserves has to go somewhere. So this is where the distribution issue comes up. So the smaller domestic banks and other people's cash parked at the Federal Reserve are the passive receivers of these active reserve-based intermediation in our view. Okay. And I guess in the final 10 minutes or so, I want to talk a bit about what happened last September, and I also want to show you some ongoing evidence on what has been going on since last September, including the recent COVID-induced dollar funding crunch. So what happened last September, if you remember, is that the US money market hit a liquidity pothole in the sense that the repo rate shown in the blue line here actually once reached close to 10%. And that's an astronomical number compared to the usual stable rate, just slightly below 2.5%. Okay, what this picture shows is the intraday dynamics in rates in the repo market, in the FX swap market. This is good evidence suggesting that these two markets are very synergistic because you see that the repo rate increased and the FX swap market implied dollar funding rate also increased in lockstep. The rate pressure began in the afternoon of September 16th. The rate pressure began in the afternoon of September 16th. Repo market closed overnight. And then in the morning of the 17th, the repo market went even wilder, and the Fed announced the repo facility in the morning of the 17th, which then stabilized the market. So what was the trigger in the context of our analysis? One thing that does stand out is the 16th was a large TGA day. There was an $83 billion increase in the TGA balance. So what we can do in our sample is, for instance, we can predict what's the usual response in terms of balance sheet response respect to an $80 billion increase in TGA based on our earlier sample before the September event. And then we can compare the actual one-day response among our US G-SIBs actually on that day compared to this predicted response. And that's what we are showing here in this chart. Interestingly, what we find is that the US G-SIBs one-day response, at least on September 16, was actually largely in line with our prediction. Again, just to reiterate, how do we get this prediction, the point estimate and the standard error? This is based on the regression of daily changes in balance sheet activities on the daily change in TGA balances using a sample up to, but not including, the September money market turmoil. Okay, so compared to the predicted, say, 15 billion reserve drain, we saw that actually on September 16th, the US banks drained about 20 billion, slightly more. They certainly didn't underreact. And for other balance sheet items in terms of repo lending, repo borrowing, net repo lending, FX swap market lending, deposit flow, and treasury holdings, by and large, they're actually largely in line with our prediction. So in other words, I mean, based on this, at least the daily snapshot of US balance sheets, US G-SIBs balance sheet, we didn't really find much evidence that they're the problem. Okay, so there are a couple of caveats. One important caveat is, for instance, we are looking at the balance sheet on the 16th. The biggest price action and the nonlinearity actually kicked in on the 17th. We chose to look at the 16th because the Fed already intervened on the 17th. So the end of day balance sheet numbers would already include the Fed intervention, and we didn't want to have Fed intervention interfere with our results. Therefore, we chose to look at the 16th when the price behavior was still, it was outsized, but it was still largely linear. Okay. The second caveat is these are end of day balance sheet, and we could be missing some important intraday dynamics. And a very famous quote from Jamie Dimon, the CEO of JP Morgan from the last year's earnings call, is that he explicitly mentioned that on that day, even though the bank had 120 billion of reserve balances end of day, in the middle of the day, the reserve balances dipped down to 60 billion. Okay, so maybe the 120 billion is not the best measure to look at when we think about what's the lowest comfortable level of reserves for these large banks. But even having said that, just by looking at the end of day, there might still be some interesting pattern that showed up, and that's this next slide. Okay, so this next slide again shows the predicted versus the actual change. This time we're only showing reserves, but we're showing it not just for US G-SIBs, but also for foreign banks and for some other smaller domestic banks. You see here is this category stands out. So compared to our prediction, foreign banks are significantly, compared to our prediction, which is here. So we predict about minus 30 billion reserve drain for $83 billion increase in TGA for foreign banks, but their actual reserve drain was around 15 billion. So there seems to be a 20 billion underreaction in terms of reserve-based intermediation coming from foreign banks. So if you like to view this as some suggestive evidence, it's plausible that foreign banks actually have hit their bottleneck in terms of reaching a very low level of drainable amount reserves, so they couldn't deploy enough cash to support additional lending on this difficult TGA day. All right. then the next question is what happened afterwards? Many things, the world has changed, not immediately. So what happened afterwards immediately after last September money market turmoil is on the 17th, as we discussed, the Fed reestablished repo facility, which allowed the broker dealers to borrow additional money from the Federal Reserve's repo facility. So what we see here is that the repo facility, plotting since September 17th last year, it was actively used soon after the money market turmoil in September, and also around the year end. Year ends are even worse funding condition, have worse funding condition compared to a quarter end, in part because, for instance, the GSIB surcharge, another capital regulation that's largely assessed based on the year-end snapshot of large banks' balance sheet. Okay, so we see there's large active repo facility take up from the Fed among our US GSIBs. And this was the COVID March funding crunch, right? You see our large GSIBs, thinking about these are the large guys, right? If you remember from our balance sheet summary statistics, these are actually the guys that actually experience a large deposit inflows. So if you like to think about, these are the guys maybe that are least affected by these short-term funding crunch. But nevertheless, they increased their repo borrowing from the Federal Reserve by over 100 billion in March this year. So there is one additional insight from this chart is we show there is a significant amount of negative correlation between repo borrowing by our GSIBs from the Fed and their net internal borrowing from their affiliated commercial banks. So what this means is that the official borrowing from the Fed and this reserve-based intermediation could act as substitutes, right? So if the banks are able, for instance, to borrow quite a bit from their affiliated commercial banks, which then use reserve to finance it, as we discussed, they may not need as much of liquidity from the Federal Reserve. Whereas in this period, when they borrowed a lot from the Fed, they didn't need to borrow nearly as much from their affiliate broker dealers. Going back to Linda's question, this is where this is when the frictions, for instance, regarding the intra-firm liquidity sharing could be at its highest level. And that's the episode where banks may find it to be more natural, more advantageous to borrow directly from the Fed as opposed from their affiliate subsidiaries. Okay, and I think that's pretty much actually, I just ran over. I didn't realize it. Apologize for running over. It's time to recap. So in this paper, I think we're making an argument to argue that maintain ample amount of reserve balances is very important to facilitate liquidity provision. It's very important for well-functioning of a dollar funding markets. And it's important to understand the internal transfers between the broker-dealers and a non-broker-dealer subsidiary within the same bank holding companies. And this speaks to the synergy between the traditional banking and the shadow banking. And I'll just end here and look forward to more discussion.
Thank you, Wenxin, for this excellent talk. And now we're open to Q&A. If you have any questions, please feel free to raise your hand or send your questions on chat. The first question comes from Pierre-Olivier. Pierre-Olivier, you're free to talk.
Yes, hi Wenxin. That was a very interesting paper. Can you hear me?
Yes, I hear you perfect.
Okay. Yeah, I want to come back to this question of this reserve draining intermediation. I mean, if I roll back the clock and think about the way this was working, you know, in the first half of the 2000s, so before the global financial crisis, I mean, it was already the case that you had depository institutions and you had broker dealers. The main difference is that the depository institutions didn't keep any of the excess reserves. So they were sort of already doing what you're describing there. They were doing sort of the internal repo to the broker dealers, and the broker dealers were channeling these resources into the FX or other types of lending. So it's what I'm trying to understand is what these kinds of frictions that you're alluding to between the intra-firm transfers. What is the nature of those frictions that is impeding this this kind of internal repo that you're describing? It used to be the case we had that, and we don't anymore. There are restrictions, and so you mentioned I think the resolution planning. but I'm sort of, I want to ask a broader question. What happened?
Yeah, so like it's the question is more like what's new, right? I think you're absolutely right. There's always some frictions. I mean, we don't even have to appeal to regulation or self-imposed risk management practice. There could also be organizational frictions. Right? I mean, each of these subsidiaries has a significant amount of autonomy when it comes to their business operations and may not be willing to share as much of liquidity across subsidiaries. I think one thing that's very different, and also as you brought up, is now the whole system has lots of reserves post-crisis under the QE, whereas pre-GFC, right, without QE, the whole system didn't have any extra cash. So the excess reserve was zero pre-GFC, and there was a very active interbank market. So some banks on certain day had more, other banks a little short, and there was an interbank market to share liquidity. So I think that's the key difference is now the whole system is flooded with a huge amount of extra cash. And when large, especially aggregate dollar funding demand shocks actually happened, it's a question about how to allocate these extra cash. And more specifically, if you think about the constraints, like one concrete example is the IOER difference between the Fed and the ECB and BOJ. Right? I mean, on the swap basis, the interest on reserve is more attractive actually at the BOJ and at the ECB. They're all central bank reserves by the most credible central banks, all counted as level 1 HQLA for the LCR purpose. So there has to be some constraint that the banks is hoarding that liquidity at the Fed as opposed to earning more at the ECB and at the BOJ. So I think that speaks to the unwillingness to move that liquidity around perfectly freely.
Thank you, Wenxin. We'll ask for another round of questions. I see a raised hand from Ricardo Reyes. Ricardo, if you are here, you're free to talk.
Sure. Can you hear me? Just went. Yeah. So I wanted to follow up precisely on the discussion you guys just had, which is, I mean, this ability to drain reserves depends, of course, on whether there's a lot of reserves or not. And so the substitution between these two forms should be radically different 2005 or 2015, just on the supply of reserve changing. But taking that further, the size of the balance sheet of the Fed, or say the size of the reserves, should have a very big impact on these estimates you're getting and your ability to substitute. So if you try to do some of these regressions, especially when I'm thinking about your TGA regressions, where you look at to what extent did these spreads change with changing TGA balances, nothing stops you from doing that in 2005, 2011 after QE1, as well as 2015 after QE1, 2, and 3. And I would think that the theory behind what you were saying would say that those estimates should change in a very clear pattern. So is that an attempt to at least test what you're saying?
Yeah, absolutely. I actually have tried that. We have tried that exact exercise. So if you think about, I mean, even though these are not the best identified shocks, right? The TGA change has some component that's highly predictable. For instance, the treasury issuance and redemptions. But still, I mean, if we use those to run regressions and call the price elasticity as estimates out of those regressions, we do find those price elasticity has increased significantly in recent period when the Fed balance sheet was contracting. And I think, so this is more broadly speaking, if the overall reserve in the system is low, the money market rates are more volatile. So a small shock or modest shock could actually lead to a much larger outsized price effect. So this speaks to the argument again in favor of maintaining ample fund reserve. If you think about interest rate versus balance sheet policy, there's additional benefits of using the balance sheet policy because it can facilitate the intermediation of these dollar funding markets.
Thanks, Wenxin. Next question is from Vania. Vania, do you have a question to ask?
Yeah, so thank you. So it's a very interesting paper, and I just wanted to elaborate on a comment I made in the chat. So the moment I saw the presentation, immediately I thought of ring fencing in the UK, because the type of essentially frictions within the holding company you described were implemented in the UK at the beginning of 2019. So of course, this will be applicable to the pound liquidity rather than the dollar. And it's not a global currency the way the dollar is. But it's very interesting because what happened essentially with ring fencing, now the retail banking division is quite constrained in terms of providing lending to, let's say, the rest of the companies within the holding company. And now naturally, actually, given the low interest rates and given the lack of profits in the retail division, that is the most natural place where they're probably holding all of this excess reserve. So you can potentially look at that data. I know you don't have the granularity, but you have a nice natural experience there, experiment there, and a structural break that you can consider. That's it.
Yeah, very interesting. Yeah, definitely. Thanks a lot. Yeah, precisely. So I think, yeah, I think the total amount of reserve is certainly important, but these frictions matter too. I guess the best example to illustrate that is last September. If you look at the total number, we still had $1.4 trillion of reserve, right? If we don't appreciate any of these ring-fencing and sort of trap liquidity type of arguments, we might thought it was already plenty, right? But then the money market actually didn't take it. There was a big sort of a distress period. So the level in the system might be seemingly high, but still inadequate due to these additional considerations.
The next question comes from Linda.
So Wenxin, just following up on your answer to Pierre-Olivier. So under the very ample reserves regime, I think by your logic, it suggests that intra-bank market flows would have collapsed as own reserve balances are used instead for liquidity management. So has the intra-bank market collapsed?
Great question. I think yes and no. I mean, I guess the concrete evidence is, for instance, the Fed funds market is much smaller now. Right? We're talking about maybe 60 billion today, which is a pond compared to the ocean of repo market, which is over $3 trillion. And the repo market is largely not intra-bank. On the borrowing side, it's the large banks borrow from money market funds. On the lending side, large banks lend to hedge funds or to smaller banks. So it's not large banks borrowing from each other in terms of sharing liquidity. So I think in that respect, and also the LIBOR, right? The LIBOR doesn't have the I in it. There is still unsecured term borrowing, but this is again where large banks borrow from money market funds or borrowing from cash-rich corporate treasurers as opposed to borrow from each other. So I think that's consistent. There is a lot less interbank market, at least among large banks.